And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show as we grind through this week already. And of course, yesterday, markets had a very nice kind of rally all day long. There was some headlines that came out. Scott Bessent was talking about the fact that we're getting deals done. Got the markets rallying, got up about 3% yesterday during the day. Then a Reuters headline came out and said, yeah, but it's going to take months and months and months to get there, so markets sold off a bit. And then we rallied into the end of the day as Trump announced that he's not going to fire Powell. Just stop worrying about that. He says the headlines just blew it all out of proportion. Reality was, we talked about before here, is that he can nominate the Fed chairman, but it has to be passed through the nomination process in government. So you can't just fire him without cause. And obviously he doesn't have any cause to fire him. So this was a nice way to just put that whole argument to bed. But importantly, that, along with the announcements now of deals being negotiated with 18 different countries, and most importantly, the one thing that we've been talking about for a while is that there needed to be some relaxation with what was going on with China. That happened yesterday. So we got that news out. Markets are going to be up about 2.5% this morning right out of the gate. We'll see if the market can kind of build on that today and if there's no other kind of headlines. But officially, the Trump put was engaged yesterday. So this was, as we've talked about here before, all these tariff concerns were going to get revised at some point, and it was just a function of time until we got to either a point to where we just ignore the tariffs entirely and just move on to other business, or if we start announcing deals getting done and starting to back off some of the more aggressive posture. That's what the market was looking for, and the markets kind of saw that yesterday. Now again, we're not out of the woods by any stretch of the imagination, so we've still got a lot of work to do with this. There's been a lot of technical damage to the markets. But again, we started to see that rotation out of risk-on assets back into risk-off assets. So we saw that rotation yesterday. Gold was down pretty sharply. It'll be down again this morning, about 2% or so. This morning, markets are going to be up about 2%. But as we talked about, that's that. Money doesn't get destroyed. It just moves from one place to the other. So whatever was rallying before becomes a source of liquidity to come by whatever's now going up. And so we'll kind of see that rotation a bit more today. More importantly, the volatility index is beginning to drop. So we're starting to see that pullback and concerns over risk in the market. So that's giving the markets a little bit of a boost here. But again, want to be very, very cautious here because economically, the data is slowing down very quickly. If you take a look at new orders that are coming in from some of these Fed surveys, those are dropping sharply. Leading economic indicators just posted a 9-year low yesterday. So that, those outlooks, and of course that drop leading economic indicators was driven largely by the drop in the S&P. But nonetheless, we are seeing significant signs in the economic data that the economy is slowing down, and that's going to lead despite the fact that the S&P is increasing their earnings estimates for 2026, those estimates are going to come down because the economy is slowing down. That is going to weigh on markets because of forward earnings expectations. So again, I can't stress enough that even though we're going to have a rally here for the last couple of days, we're not out of the woods yet. And I'm not saying we're going to have a big major bear market. I'm not saying that at all. But we're also not going to go roaring back to brand new highs. So what's interesting in the markets right now is that retail investors are piling into single stocks. They're taking on a lot of risk in the markets right now, trying to chase the bottom, so to speak. And that's could work out. That could be okay. But typically in this type of environment where we are, and as we'll go through here in a second, the technical damage has a lot of work to do to finish up here. So the risk to markets and the risk of another retest of lows at some point is certainly not off the table. Does it mean it has to happen? Absolutely not. But it's certainly not off the table. Let's talk about the markets real quick. Here's what you need to know before the bell this morning. So, we talked about before, markets had gotten very, very oversold here, and we were back on a buy signal. Now, we were really close to turning that little short-term buy signal from a very low level back into a sell signal, but that rally yesterday saved it, and this rally today will help, presuming that we can hold the rally today and nothing goes wrong. We'll certainly keep that buy signal in place. So again, market's got 3 standard deviations oversold. We're still pushing 2 standard deviations here even as we speak. So, markets still remain fairly depressed from their moving averages at this point, which gives us some ability to move higher here short term. But, kind of one of the key things that we, have talked about here is these retracements in markets in particular. And we went through this process with this 61% Fibonacci retracement. That's a pretty deep retracement normally for any type of a market move. So, when we trace a move, we can set these kind of retracement levels up. Normally, markets trade between kind of the 23.6 to 38 to 50, kind of in this upper half of the range is normally where corrections occur during bull markets. It's a bit unusual to get down to these lower levels. They do occur, but they tend to occur like during 2022, where you have a kind of a continuation of a grind. You have a rally, a decline, a rally, a decline, kind of working your way lower. And again, when we go back and look, that was kind of the model that we laid out previously in the article last week, saying, this correction that we're in looks a lot like we were in 2022, but a bit advanced because of the very deep negative sentiment, negative positioning that we're seeing kind of across the board for professional investors in particular. We're kind of tracing that same type of process out. So again, this rally here, not surprising, but we're about to run into the 20-day moving average. That's first level of resistance. If markets can get above that, you've got a decent rally up to about 5,600, 5,650 before you run into the 50 and 200-day moving averages, which have now crossed over. So you have a lot of downward pressure at these higher levels of the market. So again, a rally back to 56, 5,700 would not be surprising at all. There's a lot of pent up kind of momentum in the markets that if the markets can get moving or a lot of short covering, that's going to push stock prices higher. But again, as we move up to those levels, there's a lot of trap longs. A lot of people that got caught into this sell-off have just been looking for an exit. And so when they get kind of back to, somewhere where they were earlier this year, they're going to I'm out. And you're going to get a lot of selling kind of around that 5,600 levelish if we get there. So again, first hurdle, got to get above 5380, which is around where the 20-day moving average is. That gives you a shot up to about 54, 5500. But again, at that point, I would consider taking some more risk off the table. We added a short position. Our portfolio will probably add to it at that level. Reduce cash level, increase cash levels a bit more, rebalance the portfolio. It doesn't mean sell everything, but we'll start kind of shifting the portfolio a little bit, becoming a little bit more defensive, because most likely before we get through this process, and particularly as we get into the summer, we start seeing slower economic data, be able to monitor the risk of recession a lot more closely, this market's going to struggle here a bit more kind of within this kind of short-term downtrend that's building in the markets. But, kind of a key is right now as we're watching is that we've got this kind of this wedge pattern being built here. So if the markets can break above that, that's going to be kind of that initial impetus to get up to a higher level. And again, I can't, suggest enough that you do a bit of risk management at that level. It's now, look, anything's possible. We could rally right back to all-time highs. Anything's possible in this market. I wouldn't count on it though. The odds is that level of resistance, these higher levels are going to be pretty tough, and they'll probably hold there for a good bit. Another retest, a bottoming process, and then that'll set us up to really put in a good firm bottom for the markets later on this summer, potentially kind of September, October-ish, to get set up for a rally into the end of the year, kind of resumption of the next market cycle. That's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff. Got a lot of stuff to get into about the Trump put, what's going on, all that this morning. We'll get into it right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a few things to talk about this morning. Danny Ratliff joining me. Danny, good morning. How are you?
Hey, good morning. Great.
Good. How's things going lately?
Fantastic.
Really?
Yeah.
That's not what I heard this morning.
Oh.
Heard you were throwing cologne across the house because it wouldn't work right for you, and just,
I don't know about any of that, but nothing was thrown, maybe dropped.
I know, but it's more dramatic when I say thrown. So
Of course. Everything's more dramatic with you, Lance.
Exactly.
Come on.
So, but yeah, no, this has been an interesting market. And again, you work directly with, kind of our higher net worth clients. So it's kind of interesting to get all the perspectives that we see from, talking to a variety of individuals who own businesses. They are, higher up executives in companies, and kind of seeing what they're saying about, the markets, the economy, what's going on. So it's kind of been pretty fascinating that it's really, I've seen a lot of, kind of almost bifurcated. Like on one side, everybody's like, oh, this is great. The stuff we're doing is awesome, but the market really sucks.
Yeah, I mean, there's so many different perspectives on what's going on right now, and it presents a unique challenge because it's not like everybody feels exactly one way, right? Some people are all for this. Hey, this is what I voted for. This is what we've needed to do for a long period of time. And they're okay with the little pain because they do believe the outcome will be that much better. But I'll tell you this, business owners, executives, people making key decisions have a very big challenge in the sense that it's a struggle to know day to day what to do. Forward guidance, initially once the tariffs were rolled out and instead of being reciprocal, they're more on deficits, you saw a lot of big corporations scrap forward guidance altogether.
Yep.
And, I think the challenge that I'm hearing from many people is that, okay, I have to reduce headcount. The cost of doing business is that much more expensive. I have to diversify supply chains away from China. And these are things that a lot of people, they've recognized that it's something that maybe should have been done a long time ago, but they couldn't find a cheaper way to do business. And so the globalization, while we hate it in many ways, is great in others because you can afford to go out and buy a flat screen TV for $500 now. Right. You can go get things for much better prices. And so we're still the most prosperous country in the world. And I don't see that changing. You know, we keep seeing all these headlines that are saying, you know, this is the end of, exceptionalism here in the United States. That's not going to be the case.
Right.
We've seen this. And if you go back and read, you know, one thing you look at is say, okay, go look at the art of the deal with Trump and just take Trump, the person, out of this. He's using this chaos, so to speak, I think, to his advantage, right? I mean, you would think. Now, listen, I know this is very frustrating to try to navigate. Business owners are trying to figure, do I reduce headcount? Where can we reduce spending? What do we do with orders? We're seeing, you know, retailers, there's a lot of reports out that inventories are exceptionally high right now because they've tried to stock up prior to these tariffs really hitting. And so these are things that can have an impact on business over a long period of time. Now, I will tell you that in the sense of, you know, different people in different maybe periods of life, there are changes and there are things that we need to think about, especially right now. We're getting so much different information. You know, you have somebody on one side of the coin saying, hey, this is terrible. We're getting into the Great Depression. You have other people saying this is a great buying opportunity. And you get the paralysis by analysis. And that presents another problem for many people is that they're just stuck. You don't know where to go, what to do. And, you know, I say this often, Lance, is that, you know, you need to have a plan. You need to go back to it. How has your portfolio actually performed? And what's interesting is that I have a handful of clients that are nearing retirement or right in retirement. And it doesn't matter what the portfolio has done, even if it's performed very well compared to overall broad markets. Mm-hmm. They're scared. They're concerned. And I get it. I understand it. This is your livelihood, especially when you're stepping into, you're flipping this switch from an accumulator to a distributor. That is a big enough hurdle to overcome psychologically in of itself. But then you throw in, okay, hey, now I don't have a paycheck anymore. Now markets are declining. Now bond prices are up. I saw an article last night. What are retirees to do with bond prices, with the volatility in bonds? I'm like, wait a second, hold on. Step back, put this in perspective. We're at 4.3 on the 10-year right now.
Right.
We got down to 3.9. We got back to 4.5, which we were there a month and a half ago, 2 months ago. Yeah, we're seeing volatility, but this isn't the end of the world. Your portfolio from a bond perspective is probably very similar to where it was not all that long ago. And sometimes
the difference, though, is that stocks are down at the same time.
Well, that's right.
And so it amplifies it.
No, it certainly amplifies it because it's not that hedge that they have been. But when did they spike? 2 weeks ago?
Yeah.
Can they not drop just like they went up? Absolutely. Scott Bessent's coming out at 9 this morning to talk. He could push these rates down all on his own. You could see a number of things that occur. Trump just took a different stance overnight with Powell because I think he understands he needs to be his friend.
Well, and again, you know, this is kind of my point earlier is that, you know, regardless of whether you like President Trump or hate him is irrelevant. He's the president, right? So he's going to do what he's going to do.
Yep.
But, you know, I thought he could have approached, and if I was president, right, I would have approached this a little bit different. Even if I don't like Powell, I do need him to cut rates. And sometimes it's better to make a friend of somebody than an enemy.
Absolutely.
And so when he comes out and he kind of attacks Powell and says, well, you know, he's too late and he's always late and I'm going to get rid of him as soon as possible. That puts Powell on the defensive. So now Powell just psychologically is like, well, I'm not going to help you. But if he would have approached it as, look, I'm going to sit down with Powell and we're going to have a conversation about, you know, what my goals are, what my plans are, and I'm going to work very closely with Powell to start bringing rates down. I think that would have, A, done better for the markets.
I agree.
And then, B, he probably would have gotten better support from the Fed, at least verbally. Again, you know, the Fed does a lot of work through verbal cues to the markets by speeches they make, et cetera. And even if they weren't going to cut rates, he could have tailored language to be a little bit more dovish to help the administration achieve its goals. Because the one thing where Trump made a mistake with tariffs was to do tariffs before you did tax cuts. Because you had this impact of these potentially higher prices on consumers, but they weren't getting a break on tax cuts, and you didn't kind of have the infrastructure in place to do tariffs, and so he kind of did it backwards.
Yeah, well, he did that the first term, right?
Yep.
So his first term he did the tax cuts, then he did tariffs to give that buffer, and honestly, it did work. But I think the difference this time was maybe that, I mean, we heard how he continued to say, even Bessent was saying, this is President Biden's economy. We're getting rid of all of the excess. We're getting rid of all the things. We're making things right from a trade perspective. And then we're going to look over the summer to do tax cuts. Because they kept saying 6 to 9 months, this is Biden's economy. Now, let's be clear. That only lasted so long when, I think if he would have gone with truly reciprocal tariffs, the market.
That was also the other mistake, was using deficits. And that was Lutnick and Navarro.
Yeah.
And if he really wanted to get a boost to the market, fire those two guys.
Oh, absolutely.
And the markets will scream.
Well, but I think that was the biggest mistake, is that going out on deficits and not being reciprocal in nature, because the market had everything else priced in. We'd already seen quite a bit of volatility leading up to that. And then it just caught the market by surprise. Like, whoa, you guys have been on every media outlet. You've been talking about this. It's going to be one way. You came out with something much different. Even, I think, us, including many other money managers, we're all looking at this saying, here's best, here's middle case, here is the worst case scenario. And this exceeded the worst case scenario and has shocked the pants off the markets. Now, because I think that they've been saying, hey, 6 to 9 months we're dealing with President Biden's economy, that they thought they could cause a little bit of volatility, reduce interest rates. There's a ton of bonds, U.S. Treasuries that are maturing. They have to basically reissue. And so where do you want to do it? At lower rates? If you're earnest about cutting interest rates, that is what you'd like to do. So you create that volatility, the unknown, to get rates down, and then you become the hero. And I could be way wrong as far as the strategy methodology behind it, but they become the hero with tax cuts. They issue more deregulation. For as much as they talk about deregulation, they've done some, but they haven't done nearly as much as what you would expected right off the gate. So you wonder if this wasn't part of the strategy and the plan to say, hey, you know what? We get the volatility. We see the market decline some. We get interest rates down. We refinance that debt. And then, look, we're the hero now. We've reduced, we made tax cuts permanent. We did a reduction in corporate taxes, put more money in their pocket. We worked out better trade deals. And boom, we're doing deregulation. Now, if a deal's worked out with China, market's likely going to run significantly. Right? I mean,
well, again, that was part of the rally yesterday.
Yep.
Was this comment that was made that basically they're starting to make progress with China, and that we're going to be very Trump's exact words, we're going to be very nice to China. That was his kind of cue that they're going to. And again, this was always, and you and I think you and I specifically talked about this. It wasn't you and I. It was and Mike and I did particularly, is that, this was always stick and carrot, and that ultimately we're going to get to the carrot, and we're starting to see that now. And that's all the markets have been wanting, was to see a bit of that trade tension get relieved. And there's a lot of pent-up buying demand in the market. So again, this is why you're seeing the markets rally yesterday. You'll see them rally again today. So as long as Trump kind of moves towards this easier posture, particularly on China, that's going to give this market the ability to at least rally here for a good bit. Again, as I said, at the opening of the show during what you need to know before the bell, is that we're set up for a very nice rally, but it's not the beginning of the next bull market. And there's some key levels that we need to pay attention to. We'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the
tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
Realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Can we get to really big news today? Important news. Today is 110th anniversary of Oreos.
Oh, man.
They are celebrating it with a new Oreo cookie flavor called chocolate confetti cake.
Chocolate confetti cake.
Yeah, so 110 years. That just makes your whole day better. Doesn't matter how bad things are, eat an Oreo.
The Real Investment Show podcast.
When's the last time you had an Oreo?
1911.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So we touched on this a little bit earlier, and look, as Danny was just going through, there's a lot of things that are going on right now between the administration, between what Trump's trying to do, what he is doing, how it's interpreted, what spin you get off of it, depending on what side of the media you're on, etc. But Danny mentioned a couple of things that are really kind of key, and I don't think he even realized what he said that are really kind of key. But we had this big surge in inventories. People trying to front run tariffs. Well, what people don't realize now is that everybody's watching the Atlanta Fed GDP. Is like, oh my gosh, we're going into recession. Risk of recession indicators are now up to like 54%. People are becoming concerned that we're about to be in a recession. That inventory build is about to feed into quarter two GDP. Inventories are a part of the GDP calculation. And that big surge in inventories, that inventory build is both a positive and a negative. It will feed into quarter two GDP, so GDP will be stronger than what people are expecting. But the other side of that coin is that also now I have to liquidate that excess build in inventory because the world didn't shut down. We still have supply lines that are open. As these tariffs are eased, people are going to be able to go back to buying the stuff that they need. And then I've got to start liquidating that inventory at reduced prices, which is deflationary. And this is one of the key kind of factors that we need to be paying attention to. There's lots of headlines about tariff risk and those type of things, and that those are going to cause this big surge in inflation. That's likely not going to be the case, and there's a variety of reasons for that. But the biggest one really kind of comes down to consumer choice, and consumers are very crafty about finding stuff that they want at cheaper prices. And just kind of an interesting, theory, right? Right now, there's basically no tariff structure between China and Europe. So what if you could set up a business in Europe, as an example? And so my kids, they love Shein, right? It's a Chinese company, and it sells really cheap crap. Like for $5, you can buy a whole wardrobe. And they'll ship it to you. Well, Shein's under a lot of pressure right now, obviously, because of the tariffs between China and the U.S. So all of a sudden, they can't sell their stuff as cheaply as they could before the U.S. because of those tariffs. But and again, I'm not saying this is what I'm saying is this is an example, right, of how tariffs work and how consumers work. Well, my daughters can't buy from Shein directly, but what if somebody set up a business in Europe that bought the product from Shein and then sold it from Europe to the U.S. where there's a reduced tariff? So all of a sudden, you could buy from this other company the same products at a cheaper price. And so while there is a valid economic argument that tariffs lead to higher inflation because it's simply a tax, consumers are very, like I said, crafty about finding other alternatives to get the things they want. And this has been the one thing that over the years has been a consistent truism of the markets, which is to never count the consumer out. There's been many times it's like, oh, the consumer's just got so much debt, or the consumer's this, and then somehow magically they show up and they just keep buying.
Oh, they've been so much more resilient. We saw credit card debt at all-time highs since October 23. And you and I have talked about this over and over. I'm like, how is this continuing over and over again, right?
Well, then we get buy now, pay later.
Yeah, well, that's a big part.
Yeah.
But, at least we think.
But that's what I'm saying is like, before buy now, pay later, consumer credit card was all-time highs. And everybody's like, how can this go on? And then we get buy now, pay later, and we give consumers all these options to buy stuff that they couldn't do before.
Yeah, and so this is something, though, that can continue. And so a lot of, there's a study done by NerdWallet, a survey, and it said 85% of people are concerned about tariffs, what it's going to do for them and their money and their household, right? And rightfully so. Now, you mentioned the inflation aspect. Initially this is likely inflationary, but what does it lead to? It leads to that deflation. So you talk about inventories. Had an interesting conversation with a client a couple of days ago. They own a business, sell to large wholesalers, think like Costco, Sam's Club, Walmart. And he said, listen, right now you're having to make decisions for Q4. So these businesses are ordering. He's like, think about this. Christmas could be done because they're not going to order all this stuff from China. You're not going to see all this stuff. So we're not going to see Christmas in July, because now it seems like it gets earlier and earlier. All the Christmas goods come out.
Black Friday starts in May, I think.
Yeah. But it was interesting, the perspective. He said, listen, all the things that are being bought right now, we're working with their purchasing departments, procurement, is something that'll be reflected in Q4. And so while we talk about inventories now and while prices will effectively have to get cheaper, but in the interim, if a deal's worked out, they also said, hey, if a deal's worked out within the next month or so, things are likely okay.
Yeah.
We can weather this storm in the interim. But, there's an extreme amount of frustration, out there. But that survey said that 85% have concerns about tariffs. The majority of people were looking to make changes, right? So 45% plan to spend less on non-necessities, 33% intend to spend less on necessities, 30% plan to save more money in an emergency fund, and 14% are anticipating paying less on their debt. So credit card balances, if you have credit cards, those, that is a snowball, right? And so if you're not paying on that and you have a big balance there, and one thing we're seeing also, decline rates have gone up substantially, so you can't do as easily a transfer. A lot of people are doing, hey, I'm going to transfer this credit card to this one. I'll get 0% for the next 12 months, 18 months. It's not as easy to do as banks are now getting a little bit more stringent on lending. So I think this could spell trouble in the sense that, okay, maybe this isn't some, you've talked about this. This is more event-driven than structural. But that self-fulfilling prophecy that we get ourselves into when everybody cuts back, and I'm talking to many different people from all over the country, and they're cutting back and saying, you know what, let's wait and see. Let's see where this goes. We'll put these things off. And many times, we update a financial plan. We say, listen, we anticipated within your plan, not that I think we'll ever get there, that you're going to have a much more significant decline in your asset value. And yet you can still meet all of your goals. But intuitively, when things are bad, we all, or just the unknown that is there, we all cut back. But, if you don't have savings, one thing I was happy to see is that people are putting more into an emergency fund. But that's something that I feel like is the absolute foundation of your financial well-being. It's something that needs to be done. And that's something that we continuously put off because everybody tells us, oh, fund your retirement account, fund this. But you need to create that because once you get that foundation laid, then there's so many more opportunities that open up, especially in an environment where, hey, you could lose your job. You may have other financial hardships. You could see companies, instead of just necessarily cut headcount, they may cut your salary. Mm-hmm. We've seen that many times. And so how are you going to make ends meet? And so I'd prefer most people have had that already set up. However, there's no time like the present. Go work on it now. But that's one thing that I think that we may see if we got into a recession is that we kind of did it to ourselves in some ways because we cut back, which I'm okay with. You got to protect your household.
Well, but that's the way recessions occur. And this,
correct.
And this is the misnomer, right? Is that this action is going to cause a recession, or this action is going to cause a recession. And we've seen this so many times, then we don't get a recession, right? But in reality, we can talk ourselves into a recession because, again, if you increase the fear level on consumers, if I keep telling, most of the things that happen in the market are driven by the media, right? Yeah. If I keep pounding in this idea that there's going to be inflation, and then I go take a survey of individuals and say, what do you think about inflation? Well, I think inflation is going up. Well, the reason they think that, their expectations, is because that's all they hear in the media. But or if you tell people, hey, a recession's coming and we're about to have massive job losses, then everybody starts to contract spending. They back up. They stop doing what they were doing, and then you get a recession. So part of the issue with the media is that, and this is the same with the Federal Reserve. One of the reasons the Federal Reserve is so careful about what they say is that if they come out and if the Fed ever came out and said the truth, which is, man, there's a lot of problem in the repo market, or there's a huge crisis in the bond market. Well, immediately there's a huge crisis in the bond market because the markets will respond that way. So so the messages that you get, you always have to kind of parse through this stuff and realize that these messages from the Fed, from Wall Street, et cetera, are very well crafted to not elicit a response in the markets to a degree that causes a big decline. Because again, once you start that process, and we just saw this recently with this whole market decline, is that markets were fine. We were down a bit. We were down 8-9% from the peak, just a normal correction. Everybody was expecting a 10% kind of tariff rate, and then they come out with Navarro and Lutnick come out with this insane trade deficit measure that nobody was expecting, and then that just immediately led everybody into a panic, and that's what caused that panic-driven sell-off. Well, now we're starting to get past that. But to speak about tariffs, we've talked about this before. Jan Heisetis,
good luck.
Heisetis, whatever, from Goldman Sachs. He actually had a very good comment about the impact of tariffs on the consumer, and we'll talk about that after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So during the break, I went to look up just real quick about the proper pronunciation of Jan Hyatt's last name. Can you give me sound on my computer real quick? So this is the proper pronunciation. It's German, by the way. Actually, it's kind of based between German and Czech. It's also considered to be one of the most difficult names to pronounce. It's 4 out of 5 on the difficulty scale.
Jan Hatzius.
There you go. Hatzius. So there you go. So now we know. Anyway,
it's not that difficult. But it's just when you read it,
correct. Anyway, there's actually entire YouTube videos on the pronunciation of his name. So, anyway, so he put out a tweet, and this is something that we've talked about before, is that, when it comes to tariffs, and this has been one of the misnomers in the markets, with tariffs, and again, this mostly comes from the media, is that tariffs are inflationary. And you would think that because, immediately it increases the price of goods, right? Because you're adding a tax on top of the product or good or service that you're buying. So that would certainly seem to be inflationary. But again, consumers respond in a different manner. And he laid this out very well in a tweet. You can bring this up for me, Brent, if you want. Never positive with tariffs. Tariffs increase inflation initially. Again, you add a tax to it. Tariffs result in deflation. Why? Because tariffs are taxes. And because tariffs are taxes, it crunches demand. You have slower demand. And so as you have slower demand, that fall in demand reduces the ability for corporations to sell things at a higher price, which means they have to now sell stuff. And remember, we have this big inventory buildup. They now have to sell that inventory at a lower price, which is deflationary. And corporations got themselves into this problem. They all ran out to buy stuff, which created a supply-demand imbalance. So we saw prices go up on imported goods ahead of these tariffs. So they went out and overpaid for the inventory to bring it in. So now they've got high-priced inventory and this rush to get ahead of inflation, and now they won't be able to sell it at the same price or higher because of the decline in demand for those goods or services. So deflation occurs with recession always. And that's the most important line. Deflation occurs always in recessions because recessions are about reduced demand. And when you have reduced demand, you have to lower prices to sell a good, product, or a service. So, this is going to be one of the big issues later this year. And again, the Federal Reserve is still looking at their 2% target rate. We're already seeing, inflationary pressures decline on a lot of fronts. There could be and the other problem is that everybody was assuming that these onerous tariffs were going to be put into place. But as we're now finding out, this is one of the reasons the markets are rallying here, is that, wait, you mean the tariffs aren't going to be as much as we thought? No, they never were going to be. And now they're starting to reverse back. So now markets will start to price in lower tariffs, lower taxes, and then what does that mean for corporate profitability and earnings?
Well, in times like this, do markets price in worst case scenario or best case scenario? Typically, when we see the downside, it's going to try to price in that worst case to hedge their bets.
Right.
And then from there, if things improve, the market will front run over time.
Right. And so that's the big question. So, we talked about this last week in the newsletter in particular, is that, what we're seeing in terms of sentiment, there's so much negative sentiment, so much negative bias. Everybody's so concerned that is typical of market lows. And this was last weekend's newsletter. So if you haven't read the newsletter, I encourage you to read last weekend's newsletter because it's about the art of contrarianism and how to start looking through markets and seeing where the opportunities exist. The market itself can be under a lot of pressure, but there's still some really good opportunities that are showing up within the markets, in particularly in the equity markets, where stocks have really gotten beat up on a valuation basis. There's some really cheap stocks out there right now that will provide really great long-term returns if you can start to kind of pick through the rubble and not just be looking at headline risk and assuming that everything is going down because of that, because that's not the way that markets work. And yes, we've had this rally over the last, today and yesterday. And as I said earlier, we're certainly could potentially see that occur a little bit more. But, I've got this chart of the S&P. And, one thing in particular is that, again, as we had talked about this morning, is that we can certainly see a rally here to some degree. And again, so this kind of takes a look at that. These recent lows that we've got over here just from after that initial tariff announcement, we will probably retest those lows at some point this summer for whatever reason. But again, we're starting to see the formation of the market in particular that goes back to kind of that 2022 kind of layout. And this is something I'm touching on this weekend's newsletter as well, is that we'd laid out this premise previously about how 2022 worked out. We kept having these declines and a rally, a decline and a rally. And that led to ultimately the market forming a bottom in September, October. And that was when all of the negativity had gotten to that point. Consumers were very negative. Investors were very negative. Risk-off sentiment was extremely high. And that's where markets start to find bottoms. So again, we're probably going to retest that low at some point. Maybe, maybe not. It doesn't have to be the exact low. It could be a higher low. Remember, we talked about previously, it's about neighborhoods. It's not houses. So again, don't focus on the exact low of the market and say, okay, well, when the market gets back to that exact low of 48.16 or whatever the number is, that's where I'm going to buy stocks. That's an address. That's a house. All you want to do is start buying when you're in the neighborhood. So if you're somewhere around that low, maybe a little bit higher, maybe a little bit lower, that's okay. That will provide you, as long as the markets are starting to exhibit the sign of a bottom, that's okay to start buying. You may buy a little bit high, you may buy a little bit low. That's all right. But again, don't focus on the address, because what happens for most investors is they focus on a particular number and that number doesn't ever get hit. And so they never buy. And then they keep waiting for that number to get hit and they never buy. And then the market keeps going up and they go, well, I never got my entry point. Well, you did. The market's got into the neighborhood, right? You just want to be in the neighborhood, not that specific house in the neighborhood.
Well, you also want to nibble. You don't want to jump all in either. And so
Correct.
I think that's something that many people look at. And, we hear this as well, where we may wait for a bottom, get the momentum and technicals to reverse, and then begin to step in. And everybody's like, well, you didn't buy the very bottom. Well, you don't want to catch that falling knife. How'd you know it was the bottom until it actually was in?
That's such a great point. I got into a debate with a guy on email, and he was like, "I don't understand why." So one of the biggest challenges we have as investment managers is onboarding a new client. It's the biggest challenge, period, and particularly when somebody comes over with 100% cash. There is no good way to get from zero exposure into the markets, particularly during a decline. This is the really tough part.
Well, even an up market that's expensive.
Even an up market, it's very tough to get allocated to the portfolio models, et cetera. So we just have a process that we developed over years that we onboard a portion immediately when money shows up. We buy very small amounts of our portfolio to at least kind of get a footing into the holdings that we like, and then we add to them over time as we have opportunities. Well, I got into this email debate about why we onboarded, back a couple of weeks ago when markets were near the lows. Like, why were you onboarding there when, the markets were still going down? Well, first of all, nobody knew at that point in time that the administration was come out and announce these tariffs that were so onerous, right? Nobody was expecting that.
But everybody's on the flip end in hindsight. It's like, oh, well, you should have waited. How did you?
Exactly. Yeah. That's the beauty about technical analysis. It's in hindsight, you can look at all these technical charts and say, well, yeah, if I would have bought here, if I would have sold there, look how much money I would make. That's a fallacy because you can't do that. And technical analysis, that's not what technical analysis is for. Technical analysis is a view of what happened in the past, and it helps us form ideas about risk. When investing money, et cetera, we can look at certain things and say we can assess the risk. But the one thing technical analysis doesn't tell you is when unexpected events occur, like I'm going to announce trade deficits as a tariff instead of actually tariffs, right? Those create volatilities in markets. And that's why, again, we only buy little small pieces. And then when you have that event, we can buy some more, which we did. And then we rebalance the risk from there. But you have to look at entering markets as a process, not an all in or all out. And technical analysis is great. We use a lot of it in managing money, but it's a view about what happened in the past. And the biggest challenge for investors is when they're looking at charts is to realize that's a view of the past. It's not a prediction of the future.
Well, I think that's really important to understand that part of it. But, and that's why the majority of firms out there, especially if you go to any big wirehouse or big brokerage, they're going to, funds hit an account, it's 100% allocated. And we recognize that because we are more of we're more of a buy, hold, monitor, and sell. We're active money managers. We're not day traders. We're not, trying to knock the cover off the ball every day. But in general, people come to us because we can mitigate risk to the downside, participate to the upside, and over long periods of time, you generally will see better returns because we're not having to come back from some significant drawdown. And that presents, opportunity, but also the challenges when allocating funds to markets. But, we talked real quickly about, narrative investing. Go look up Robert J. Schiller. He has a lot of books out there, but narrative economics is a very, very good one. Go check that out.
Yeah, absolutely. All right. Thank you to Danny. Appreciate it. All right. That wraps up the show for today. Be sure to like and subscribe to the channel. We appreciate it very much. And we'll see you back here tomorrow with Michael Leibowitz. See you then.